Hello and welcome to Wealth University.
Today, we're diving into a topic that affects almost every part of personal finance: your credit score. Understanding how credit scores work and knowing how to improve them can make a big difference, whether you're applying for a loan, renting an apartment, or even job hunting. In this video, we'll break down the basics of credit scores, how they're calculated, and share practical tips to help you improve your score. So, let's get started. What is a credit score? A credit score is a three-digit number ranging from 300 to 850 that reflects your creditworthiness. Basically, how likely you are to repay borrowed money. This score is a significant factor that lenders consider when deciding whether to approve you for loans, credit cards, mortgages, or even rentals. The higher your score, the more favorably lenders view you, which can lead to lower interest rates and better terms. Scores above 700 are generally considered good, while scores below 600 could mean higher interest rates or difficulty getting approved.
Components of a credit score. 1. Payment history, 35%. The biggest factor in your credit score is your payment history. This includes whether you pay your bills on time. Late payments, especially those over 30 days past due, can lower your score significantly. Even one missed payment can impact your score, so it's crucial to stay consistent.
2. Credit utilization, 30%. Credit utilization is the percentage of your available credit that you're using. Ideally, you want to keep your credit utilization below 30% of your credit limit. For example, if you have a $10,000 limit, try to keep your balance under $3,000. 3. Length of credit history, 15%. The age of your credit accounts also impacts your score. The longer your credit history, the better, as it shows lenders you have experience managing credit. 4. Credit mix, 10%. Having a mix of credit types, like credit cards, installment loans, and mortgages, can positively impact your score. This factor is less important, but shows lenders you can handle different types of credit responsibly. 5. New credit inquiries, 10%. Opening too many new accounts in a short period or having multiple hard inquiries on your credit can lower your score, as it may appear you're seeking a lot of credit all at once. Understanding credit bureaus and reporting. 1. Credit bureaus. There are three main credit bureaus: Equifax, Experian, and TransUnion. These agencies collect data from lenders and generate credit reports, which your credit score is based on. Each bureau may have slightly different information about your credit history, which is why your scores can vary across bureaus. 2. Different scoring models. The two primary scoring models are FICO and VantageScore. FICO is the most widely used, but VantageScore has been gaining popularity. Each model uses similar factors but may weigh them differently, so don't worry if your FICO and VantageScore differ slightly. Practical tips for improving your credit score. 1. Pay bills on time. Set up automatic payments or calendar reminders to make sure you never miss a payment. Even if you can only make the minimum payment, it's better than missing it entirely. 2. Reduce credit utilization. Aim to keep your balances low, ideally below 30% of your credit limit. If you're able, try to pay down your balance in full each month. Another tip: if you have a high balance, consider asking for a credit limit increase, which can help reduce your utilization rate. 3. Check for errors and dispute them. Check your credit report regularly. You can access a free report from each bureau annually through annualcreditreport.com. Look for inaccuracies, such as payments marked late that weren't, and dispute them. Correcting errors can improve your score. 4. Limit hard inquiries. Try to avoid applying for new credit unless it's necessary. Too many hard inquiries within a short period can negatively impact your score. 5. Consider debt consolidation. If you have multiple credit card balances, consolidating them with a personal loan can simplify payments and potentially lower your interest rate. Just remember to avoid running up balances again on your paid-off cards. Leveraging good credit. A good credit score isn't just about getting approved for credit, it can save you money in the long run. With a higher credit score, you're eligible for lower interest rates on loans and mortgages, which can save you thousands of dollars over time. Good credit can also give you better terms on car loans, lower insurance premiums, and even help with things like getting approved for an apartment lease. Real-life success stories and motivation. Many people have successfully raised their credit scores by following these steps. Whether it's paying down debt, disputing errors, or just focusing on consistent on-time payments, small actions can lead to big results. Remember, building credit is a marathon, not a sprint, but it's worth the effort. And that's it for today's video on understanding and improving your credit score. We hope you found these tips helpful and feel empowered to take control of your credit. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more content on financial wellness. Thanks for watching, and we'll see you in the next video.